Hopefully everybody will hear this later on. Now we are talking today about workshop 7, and actually I want to this is a very recent information about the final exam, and I want you to take notes about this. The final exam, as I told you, it will be an e-exam, which is different from what I had for the last few years since the COVID. This is the first time I have it as an e-exam, but I tried to make it as good as I can. Actually, e-exam is also better for you because it will manage your time. Not as I told you before, it will be off campus. It will be off campus, and this is good news. Now, off campus means you can take it from anywhere. You don't have to come to campus, and then you have these people supervising you while you take the exam. You can take it from home or wherever. Now, still the point is either is it open or closed book? Open or closed book exam? I just talked now to the education office. I received their email now. It seems like it's up to me to make it open or close. So I'll just make it open book. I'll just make it open book. I will fill in the forms to make it open book. I have question here, sir. Open book, thank you, sir. Yeah. So I will, it's up to me to make it open book or closed book. So I'll choose to make it open book. But you know, even if it is open book, you have to manage your time because it will be the first time, the first part will be the 30 multiple choice question, which is 1 hour. You will not follow, you know, to look at the books and the references, whatever, but you will have to do things, you know, as fast as you can. Details about the final exam in terms of the question, the nature of the questions, the things that we will, ask you to focus in, things I will ask you to concentrate in, chapters that will be eliminated from the final exam. All those issues will be given to you within the next 2 weeks. But I will try to make it, you know, by week 10 or something like this. Hopefully that will be okay. So if you have any question about it now, I don't think, if you have, I can answer any questions if you have. It seems we are okay, at least for now. Now for pre-class activity, it was supposed to be open this week, but you cannot just, you know, submit pre-class activities which some work and then next day you find the second one. So I will open it this weekend and you will have enough time. Guys, we are actually end of the semester. We have only pre-class activity 4. Then after that, you will have the test 3 and then test 4. We are done. We will have a revision class. Now, do you have, there is a question here. Sir, so to clarify, the final exam will be open book. I want it to be open book. Please consider it open book. I will have, but I have to fill some forms. But from us, as we talk now, it's open book. This will help us a lot. No worries. I want to help you as much as I can. This is a question. I think it's a private question, but it's an open book. Sir, so we don't need to go to campus to do the test. Please ask the questions, a general question. This is a private questions coming. Sir, do we need to go to campus to do the test? No, you don't have to do that. You can take it from wherever you are. As you are taking those tests, we are doing it now. The internal test, test 1, test 2, test 3, it will be the same format. However, we will have multiple choice questions we already know very well, and then we will have the multiple choice, and then this is the multiple choice, and then we we will have structured questions, and they will upload for you on all the exams, so you will see how is those structured questions work, and what chapters they are covering, and all these issues. I don't think you should be worried. How long will the final exam be? 2 hours and 10 minutes. 2 hours and 10 minutes. 2 hours and 10 minutes. And 10 minutes, okay? Yeah. I think anything else? Anything else? Yeah, okay. Okay. Now we are, I don't know what's the problem with this one. So let's go now to our, please log into Pool Everywhere. Now, the first question, you already have the answers, and I already sent you the answers to your email, and I will also upload it. Maybe if I do some more notes here, I will upload the one that has these notes. So now let's start now with the question number 1. So the way I planned this workshop, we don't have enough time, but I don't want to decrease the number of questions. I want you to take the whole workshop. So some of the questions I will not cover, but I already explained very well, especially the multiple choice questions here. They come with their answers here. For example, I give you the answers. This is my comments. So some of the questions, which specifically the multiple choice questions, I will not answer, I will not cover. I will cover only the important issues, and then for the sake of time, and then you can study those in your own space, and you have already the comments. Now let me go to question number 1, which is why this credit risk management is very important. Actually, it's very important because if we have good credit analysis in terms of the benchmarking, in terms of choosing the right customer, in terms of pricing, then we have actually, when we assess that risk, actually we can then decide on the interest risk, which is the pricing. This is the pricing issue. We can also talk about the maturity, which maturity we are planning to have. It depends on the risk, the credit risk, and a stable economy, and this volatility in the economy, and the economic factors and the other issues will let us take only short maturities. Then we have to decide on the collateral. Depends on the customer, credit rating, and its suitability for the loan. Then we have to decide on the collateral, and when we decide on the collateral means percentage of the collateral. Sometimes the percentage of the collateral, if we are going to take, sometimes we take 50%, sometimes to take more than that. And we have also to talk about the covenants. And covenants is, I told you, the conditions and term conditions. It's actually the term and conditions, if you can't say it, of the loan, like the leverage, dividends, as I explained it in the tutorial, whether they should pay dividends, and then reporting, all those issues will help us in the monitoring issue, which is the monitoring. Okay, now, of course, when we have a scale project, we have to have more analysis. If we don't have enough credit analysis, of course, we will end up having higher default rate, and higher default rate if we have really, very, very material one. In a way, it eats the whole capital. then we will go to insolvency, excuse me, which we don't like. And insolvency means collapse of the bank. Now, the problem is when we talk about, as I told you, this bank risk, most of it is contingent, which means when we talk about OPS, which is those type of businesses that is out of the balance sheet, they are not assets and liabilities now, but actually they are contingent asset or liabilities, then in this case, they don't have that trend, which means I cannot expect it. And this applies to the OPS, applies to, OPS can be like loan commitments. Maybe the customer will take the loan or then don't take the loan. This takedown may happen or may not happen, so takedown can be, please add those notes as I'm talking, or not, something like this, and options and interest rate, this is the derivatives. When we are, this is financial derivatives. When we are involved in this has no way to predict it. It's very, very contingent. And financial derivatives, we use it for hedging, speculation, and we can gamble with that, and we can also trade it, or we can also use it to protect our positions. Financial derivatives, we will talk about it in week 10, don't worry. But for now, and please understand that financial derivatives, there is a question here. Sir, may I know if sir will teach the week 6 topic on liquidity risk? No, liquidity risk. Liquidity risk we are not covering here. I think liquidity risk we already given some. We cover it, and we uploaded the workshop for. It was last week work. Yeah. So this is actually credit risk. Now the other thing is identify and define borrower specific and market specific factors. See, when we talk about the loans, we already know, as you see from the tutorial, we talked about the quantitative one, which is you do a benchmarking and use the balance sheet if you are talking about commercial bank, commercial loans, and we do credit, what we call a credit scoring. And with the benchmark, we decide, like when we calculate the Z value for the Eltman and the others, we decide whether we give the loan to or not. But this is very technical one. However, we have to consider some other factors. So you can say this is like the qualitative factors that we, so this is in addition to the credit scoring, we have to consider the following things. We have to consider the reputation. Now, as you can see, the reputation for small firms is a problem. If you have a firm living for 30, 40 years, they have good reputation. You find a new firm, growing, very good firm, it doesn't have reputation, then it is heritage here, or it will be a disadvantage in this factor. And this we have to take into consideration. The leverage, if you talk about the probability, linear probability model, it takes leverage into consideration. But if you talk about the Eltman, no leverage in those 5 scores, Z1, X1, X2, X3, the Z, X1, X2, X3, and X4, you can see it doesn't have any, you can look here, it doesn't have any leverage here. It doesn't have any leverage here. So in this case, this is the Eltman, for example. So in this case, we have to take into consideration the leverage. So volatility of earning. We don't like this earning that goes zigzagging up and down because sometimes they can pay us and they have a lot of money, and some other times they don't really have enough cash inflow to pay our interest. And so this is not good. We don't like it. We don't like high leverage. We like good reputation. And the collateral we have to decide, but usually we will like the collateral. We want to have a collateral. So this is issues that we have to know about what we call it. Please understand it as a borrower specific factor. This we have to analyze also in the loan, okay? So this we have to. Now also we have to look at the economic cycle, because the economic cycle is very important. One of them is when you have this up and down, if we know that there is any COVID thing coming or any crisis coming or the economy is going bad, and we have this, we understand that we will have problem in credit risk. And therefore, we have to take care today what loans to give and how much loans we give and to whom we should go give. Because some of the industries are very, very sensitive to the economic cycles, especially those what we call consumer products in industries, like buying cars and other issues. So business cycle is very important, and the level of interest rate, because please write here, especially when you have floating rate. When you have floating rate, then you have a problem. Because when you have a floating rate and the interest rate is increasing, you will increase it. You will increase that rate over the customer. Now, if Bank Nigara say, I am increasing, or the Central Bank of Malaysia or Australia or your country decided to increase the interest rate to 5%, 5% more. You will add that if it is a floating rate with your customer and his loan is for 7% business loan, and you increase it to 12%, that's fine, that's good for you. The problem is he will not be able to pay. So if you know that there is a level of interest rate going up, then you have to choose customers that can tolerate these changes. Some customers, if you just increase 2%, they cannot pay. And if they cannot pay, that means it's defaulting. Now, based on this information, I try to test your understanding in the following questions and pull everywhere. I'm sure you will do it. It's just only 4 questions. Please log in. Please log in, everyone. Let me see how you think. Credit risk analysis is important for, where are you guys? Log in. Yeah, 3, 4, 5, 6, 7, 8 student. We discussed this. I just want to see how 10. Hey, everybody participate. Okay. Really good, guys. Yeah, okay, okay. This is nice. Riskier projects require more. Is that right or wrong? Okay. Oh, thanks. Okay. Okay, let's go to the third one. An adequate credit analysis will lead to higher default consultancy. Is that right? Then we are on the same page. Then, since you are, following those issues, Also, not everybody is participating, but yeah. Yeah, this is 100%. Okay, good. Thanks. And obvious credit risk assessment is not easily predicted. I think we mentioned this when we talk about loan commitment and all those issues. Okay. Oh, then we are actually good. Thank you very much. Thank you, guest Zara, Sepi, Sisi, all those guys. Very nice guys. Arian, everybody. Thank you. Okay, let me go to something else, which is this one. I think this is very important question. If you know it, then we are good. See, when we make a collateral, this collateral sometimes we take it as 100% today. It's like a building or an asset or whatever. Usually those assets can go up, but sometimes can go down. So is there a risk in that collateral is evaluated according to market value and may or may not cover the book value of the loan? Let me present this. Is this a true statement? Okay. I don't know how many students participated in this, but it looks like everybody did. Yes. So please understand that the collateral may or may not. Also, we take it when we give the loan 100%, but the market value when we sell it, it could be less. This is the risk. More, that's fine, but it could be less, especially when we take securities or whatever. Okay. Let me go to these questions. I think we have talked about this. Just do it very fast, huh? Now see, 14 students are not actually with us. The 87% get it. The 13%, I am sure they have their own reason why they didn't take it. But financial institutions actually, credit risk is impacted by the expected level of economic activity. As I told you, the changes in the economic cycle, please write it, the change in economic cycle or the change in the interest rate, that will impact the payments of the loan and the interest of the customers. And therefore, we are saying, yes, credit risk is impacted by the expected level of economic activity. So if there is a recession or there is, yeah, that you have to take into considerations. So, and this is, I think we have discussed it here, the economic. Now, here, we talk about why reputation is important, and I already explained it. How does the existing of high debt ratio, why the leverage is important? And I already explained it in mine, why the volatility is important, and why the degree of collateral can be changed. And I think I have asked this question and discuss it and the pool everywhere. Now, this is why financial economic interest. This is when I talked about how can this financial, which is the last question now, which I think most of you get it. This is why if the interest rate increases, some customers, so it's good for us in the floating rate, but the problem is the customer may not be able to pay. Now, let me, and I want you to relate to this one. Increasing the interest rate suddenly is good for us when there is a floating rate. However, some customer may find it difficult to pay the loan and the interest later on, and according to the new rate, and they may default. Okay, now let me go to here. These questions I will not discuss the answers here. So this area, this area, this area, all the explanations here. Now I want to come here. This is very important for me that you know this one. So what I will do is, I will go to my other device, and I think I have explained it in my class. I'll just try to get it here. So I will share my other device. Because I want to write something.